Adrian Mucalov. I'm a partner at Actis. Our focus is on power infrastructure and other essential services. And our investments have been exceptionally resilient during this period. So, there's no doubt that all markets, developed markets and emerging markets, face significant challenges during this pandemic for different reasons. I think the vaccine rollout, for example, is being deployed at a different pace in different markets. But the fundamental growth in emerging markets, will continue for decades to come, right? So we believe the underlying fundamentals of growth, of urbanization, of the rise in the middle class, industrialization, there is an unbelievable need for energy, for electricity, for digital services, etc. So while this is a very difficult time, it certainly imposes fiscal pressure on governments around the world, and they'll respond differently, and you have to look at each investment opportunity on its own merits and look at the risks. We think that fundamental growth, absolutely remains in emerging markets. And we even think of it sometimes as a bit of a misnomer to call it emerging markets. These are the markets where 85% of the world's population lives in what is often termed emerging markets. So in our view, this is most of the world, and this is the part of the world that is contributing to most of global economic growth for the next generation. The question is, how do we manage political risk? This is a question certainly we receive from our investors. I always start by thinking, all markets have political and regulatory risk. I certainly would say that, America has experienced its share of political risk. Countries in Europe have political risk. Each market is unique. What's important is that you really understand the market context. Every market has political issues. Every market has regulatory issues. I would say that in general, our experience is that the actual risk that we've seen in our markets from a political and regulatory front has been lower than the perception of risk in those markets, right? The markets where we invest absolutely and fundamentally depend on foreign capital, foreign equity, foreign debt, to fund their essential services and infrastructure. So they really don't have the luxury to impose too much regulatory and political risk on foreign investors who are investing in these essential services. And that has been borne out for decades of track record in many markets. Countries like Chile and Brazil, have 20, 30 years of track record that investors can look at. And in markets where there's insufficient track record, and there are some where private infrastructure programs are newer, the governments and the regulatory bodies offer a package of protections, of risk protections and guarantees that would be unheard of in developed markets. I believe that the package of risk protections available, as well as the fact that the track record of regulatory risk actually isn't as high as people believe, presents a really compelling risk-adjusted return opportunity in our markets. Most of our investments are in some way a partnership with parts of government. So often you are still selling to a type of government agency, or you're regulated by a government agency. So it is private capital, and I like to differentiate who owns the asset. Doesn't have to be the government, right? So there is sometimes a view that if it's an essential service, the government should own the asset. But we believe firmly, especially in this era where fiscal budgets are highly constrained across the world, that the private sector is perfectly capable of operating these assets and owning the assets and freeing up government balance sheets for all kinds of other essential services, for health and education, and post-pandemic recovery. We believe that there's no reason to not enable the private sector to build and to operate in a very cost-efficient way essential service infrastructure. Of course, it should be done in partnership with government in the right way to ensure that the costs are competitive. But there are trillions, literally trillions of dollars of capital required. And we believe that in most countries, it's not the most efficient use of government balance sheet, and private sector has a huge role to play and tremendous global experience. So, why not leverage that global experience of having built, power plants and other infrastructure in developed markets, and using all that experience to build, absolute best-in-class infrastructure in emerging markets. Should investors consider greater allocations to emerging markets? I would say in our space, in hard assets and infrastructure, absolutely. When I think of the investment opportunity, where in developed markets, often we're talking about an energy transition, we're talking about energy efficiency, we're actually talking about a decrease in demand for energy in some infrastructure. In emerging markets, it's all about this tremendous underlying growth story and huge need for electricity, digital services, and other infrastructure. I think in emerging markets, investors benefit from a series of risk protections, not least of which is just long-term contracts. The idea of having a 30-year take-or-pay contract in many developed markets, that era has passed, but that is still the norm in many of our markets. So we think that the underlying contractual basis for infrastructure is really interesting. We think if you have the experience and the global knowledge, the risks can be well managed, and you can earn a really interesting risk-adjusted return because of the supply-demand balance from the investment community.